Gary from FitnessPersonNutrition.com. I'm here back with another video. Please like, comment, share, subscribe. This video we're going to talk about the Fed rate that the Jerome Powell just did, the chairman of the Fed, the other day. How it's going to affect the economy? Why did he do it? Let's see what he has to say. I haven't listened to this yet, so I just know that he cut it by a quarter point.
Below your guesstimate's break-even rate. I'd be curious to hear a bit more about that, where you think the break-even rate is. You mentioned earlier that job creation is running below your guesstimate's break-even rate. I'd be curious to hear a bit more about that, where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect, but it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. There are just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
If I may, you mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually for the upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the S&P between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
So the interest rate has been dropped by a quarter point. So he didn't want to drop by a quarter point, which is why he has not done it all year. And President Trump has been calling him dumb and an idiot and blah, blah, blah. He doesn't know what he's doing. He's threatening to fire him, even though he can't fire him because Trump's not getting his way. And he still would not have gotten his way, but the job market is not going well. So the unemployment rate is 4.3. 4.3 is up from 4.2 last month or 2 months ago. It's a little bit higher. It was 4.2 at this point last year, although we just got some revised numbers from last year that shows that about 1 million of the jobs weren't real jobs and it was false numbers, as Trump's numbers were also false this year. So let's just discount that. We're just going to say it was 4.2 last year. It was 4.2 this year. It went up a little bit. It's now 4.3. 4.3 in the grand scheme since 1990, it was like 5.6, 7.5. It's the lowest it's been in the last, about 34 years, from 1990 to 2025. The lowest it's been is 3.5, I want to say, and that was under Donald Trump, if we are to believe those numbers. If we're going to believe Biden's numbers, we have to believe Trump's numbers. It's either we trust the numbers or we don't trust the numbers. So under Trump's first term, not under this term. This term it's up to 4.3. So it's been as high as 9%, 9.3% during the financial crisis in 2009, from the 2008 fallout. But anyway, so the only reason that Jerome Powell is giving Donald Trump what he wants is because the job market is trending down. So as he said, supply and demand are both trending down at the same time, as well as inflation going up. Now, he's not happy with the inflation number. He has not hit his goal with the inflation number, but because the jobs look like they could go south, he's going to inject more money into the system. By injecting more money into the system, he's going to lower the interest rates. once you lower the interest rates, banks are more likely to lend. They have less risk. They give people better numbers. People are more likely to borrow. You can kind of loosen your regulations, your requirements, because the money gets cheaper for the bank to give out. So when money is expensive for the bank to give out, they hold on to it a little bit more, and they also have to charge you more. And then when the interest rate comes down, they then can afford to play a little looser with how they hand out money or lend money. So now that this is going down, this is what's bad. So we're going to ignore the tariffs and the possible fallout from that. We're going to assume that everything stays the same. Inflation is already too high. So inflation is things costing more year over year. So if you're not making more money, guess what? If you're not keeping up with the 3% inflation, you're essentially losing money every year. That's why they said if your money is just sitting in the bank, you're really, even if you had $1,000, if you have $1,000, I'll get the perfect example. So if you had $1,000 in the bank in 1970, and you just let it sit in the bank from 1970 to today, let's just say you got a 2% interest rate year over year. What is that? You might have maybe $3,000, but let me see. So how much is $1,000 in 1970 worth today? So you may have made $1,000. So that $1,000 is a rough. You might possibly, if you had a really great interest rate, which you might have had turn that 1,000 into 3,000 possibly. But $1,000 is the equivalent of $8,300 today. So you had $1,000 and it was worth $1,000 in 1970, but now it's worth less because now, was that 80% less? Is because you have less purchasing power with $1,000. So as opposed to if you were to put it into an investment or something like that appreciates, then you would have more money. If you put it into stocks, because the stock it was worth $1,000, it appreciates. You get dividends on it. You reinvest. There's people who have become millionaires. There's one guy, he made no more than $15. No, he made less than that. But in his lifetime, he made no more than $15 an hour. And over 30 years, he managed to, through investing, he became a multimillionaire. He died a multimillionaire. So that's less likely now, less possible now, because where the market is now, you probably won't ever see that type of growth ever again. You'll have a stock here, a stock there, but our infrastructure is pretty much set in stone. But anyway, that's a little off topic. So the point is that we're not keeping up with inflation, and I don't understand why he set the inflation level so high. I think he said that like 2%, 2 or 3% was his goal. He's over 3%. So really the goal should be no inflation, but we live in a debt society. I mean, why not 1%? I mean, it's just an arbitrary number you throw out. Kind of like Dr. Fauci threw out the 6 feet of distance thing. It's just a number that these people throw out, and they have degrees and a position, and people just follow it and think that it's okay. But that's how we pretty much get poorer year over year, the average American. Anyhow, so you give out money you lower the interest rates. Back on that. So you lower the interest rates, and then once you lower the interest rates, people can borrow money, businesses can borrow money, people have more money in their pocket because they're borrowing, they're buying houses, they're buying cars, they're getting approved for more credit and lines and credit cards, and they're going to the store and they're buying and Gucci or whatever, blah blah blah. They're buying laptops. So once people have more money, they go out and spend it. You need more employees. You hire employees. So now you have more people employed, and that's how it helps the job market. But then all these people are spending all this money, so it's the same amount of goods, but you have a lot of money going after the goods, and then the price of things go up, and inflation rises even more. Which then, once inflation rises even more, and you're still not, so we're already inflated. Things are already going to cost more. It's built into the system. It's built to the system already. So then things will inflate even more. So you will just have more people who can't afford things, but they will be employed. So I mean, it's a double-edged sword. You know, pretty much going to get cut either way. But anyway, how do you feel about the rate cut? Do you think, does it matter to you? How are you dealing with inflation? Do you have investments? Are you losing money every day? I'm losing money in some places, but I also have investments, so you know, I'm getting a little bit better with that. Uh, anyway, but let me know what you think or what you have going on down in the comments, and I'll see you in the next video.